Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary.
All right. Happy fall, everybody. Here's our next episode of Lumida Non-Consensus Investing. I thought I'd do this solo, provide some thoughts on where we are in the economy, share some thoughts on recent bank earnings that come out. We obsess over bank earnings because it's really a cheat code to understanding what's happening in the real economy. If I'm stuck on a government island or stuck on an island somewhere, I'd prefer bank earnings rather than government data. So I want to talk through that. Very interesting commentary coming out of the leadership of the banks, including around stablecoins and tokenized deposits. So I want to get to that. Also talk through some of the banks that we own, we're looking at, talk about the health of the consumer, and it should be a lot to get into. Tomorrow, by the way, I'll be interviewing Eric Jackson on the Lumida Non-Consensus Investing podcast. Be sure to tune into that. Eric was early into Carvana and Open, and he got on better. So he has an interesting story to share, I am sure. So Eric is going in front of Drake's house every day with a billboard. It says like day number 43, and he talks about what he owns and the day he's owned it. I don't think he even knows Drake. It's just hilarious. Bloomberg wrote an article about this. I'm on FSD day number 5 in the Tesla. I just started doing live podcasts in my Tesla. I don't recommend it. But yeah, it's been interesting just testing the technology. So yeah, on the personal front, been incredibly busy. We were in Puerto Rico, myself and a few members of the Lumida team. We were there most of last week in Dorado and Condado. There's an incredible amount of entrepreneurship and talent in Puerto Rico. And they're really on the cutting edge of health and longevity and investing and the latest trends. So always walk away learning more from that. But we had a fantastic dinner at the Ritz Residences in Dorado. And then Santaria was a dinner Thursday night. And we'll be back again in November and December. So if you're in Puerto Rico, be sure to let us know. It was funny because on the way back, it was last Friday, I was in the airport, and then this Trump tariff trade war, China kicked off. And I saw this picture of these tacos. Like, yeah, this is just going to be a taco. People are misunderstanding what's going on here around the supposed trade war. This is mutual economic destruction if both China and US don't get along. So Trump is focused on the midterms. His base owns stocks. People that don't own stocks don't like Trump. You can see it in the polling. He's going to continue to talk up markets. And that's what Besant did this morning. If you guys saw Besant, he was talking about how we're in a productivity boom. There's economic growth. He's right on both those statements. Fundamentally, there's a mismatch between the fundamentals of the economy and the psychology that investors have, or that many investors have. So many investors feel rattled, shaken, concerned, anxious, and yet we have data center stocks hitting all-time highs, like Flextronics. We have the S&P 500 a couple points from all-time highs. We have the VIX up 30% on Friday and 20% in a day for dropping a couple of points. So there's a lot of anxiety out there, and it doesn't reflect the strong fundamentals in the economy, strong productivity growth, double-digit earnings growth. We saw last quarter. We saw the banks crush earnings yesterday. Again, I'll focus on that here in the call today. It's like across the board, every segment of banking, investment banking, consumer banking. You don't see that with a recession. You just don't see that. The fact that we're even talking about a recession is silly. So there's just a mismatch between psychology and fundamentals, and that is because of headlines and geopolitics and social media. So keep that in mind. I hope you all remain positive and optimistic about what the future holds. Things are pricier than they were 2 years ago for good reason, right? You have technology stocks are a larger share of corporate earnings. Those stocks have higher multiples. And so the S&P valuation is higher as a result. At the stock level, you still have names like Meta, which are doing 40% year-over-year EPS growth, with a PE of 25. That's not overpriced, right? You've got like TSM with double-digit revenue growth, significant double-digit revenue growth, and 20 times earnings. It's not cheap like it was in May when it was 15 times earnings, which was a bargain, or Google when it was 16 times earning, forward earnings, which are incredible bargains, but they're not inflated either. So there's still opportunities out there. Yes, there are pockets of excess. I hope you didn't get the phone call from JP Morgan to buy into that $2 billion IonQ offering. They're by and large, things are solid, things are fine. And I think we might look back 5 years from now at a Middle East that's much more stable and safer. And so that anxiety starts to recede too. So these are things to consider, right? I'm a contrarian, as you all know, and I'm fairly optimistic where we are. And I find it just really surprising how I think people are just offsides around understanding the reality of the fundamentals in the economy and earnings growth and even continued disinflation and the delivery we're seeing on AI, right? Bank of America CEO Brian Moynihan in their earnings transcript talked about how they're seeing productivity growth in their engineering team. It's substantial. A buddy of mine is one of the CTOs there. I've talked to him about this. They're seeing significant productivity growth on the ground, their internal application delivery. So it's real. Financial services benefiting from AI in a significant way. Financial services a meaningful part of the US economy. With that said, let's dig right into major bank earnings reports. So here are the key trends. One is wealth and asset management continues to grow. So really in the wake of the great financial crisis, the major banks looked around and said, gee, investment banking is risky. Taking risk with their equity capital is risky. Let's get into wealth management, quality business model. And they've reoriented there, right? The CEO of Morgan Stanley, recently retired James Gorman, came from Merrill Lynch. They catapulted ahead of Goldman Sachs with their bet on wealth management. Solomon Smith Barney sold their wealth management business to Morgan Stanley post GFC, and they said, "Gee, you want to get back into it?" They poached people from Merrill Lynch, like Andy Saperstein, and they're rebuilding that business. So wealth management continues to work. JP Morgan saw a reach an all-time high of $4.6 trillion. That's up 18% year over year. Citigroup also, again, launching new offerings, trying to get into the game here. Investment banking, key thing to look at. Why? Because it allows companies to raise equity capital, refinance out of higher rate debt, or also refinance debt that may be coming due that was issued back in 2021 during a low rate environment, right? So there's a lot of cheap debt issued 2021, rates are now higher. What happens when companies approach that maturity wall? If capital markets are open, you can issue stock, then you get nice soft landing. And we're seeing a lot of that. So this is what David Solomon, CEO of Goldman Sachs, said. He says, quote, "Many CEOs have shifted their focus back to long-term and strategic decision-making. Sponsoring institutional activities now tracking 40% higher versus last year. Long-term and strategic decision-making means they're interested in doing M&A, mergers and acquisitions. Merger Mondays are back, right? If you guys remember that, we had that, seem to have it every few years, M&A Mondays, and also IPO season. Obviously had a very brisk IPO season the last few quarters. JP Morgan's investment banking fees up 16% year over year. Quote, the CFO, broader strategic dialogue and strong demand for refinancing and M&A. Citigroup IB fees up 17%. So the whole category, the whole pond is moving up and to the right. That's great. Those are good signs for the economy. I don't need to see the non-farm payrolls data to see that the economy is doing fine. By the way, that series is so noisy and so misleading. Like the standard error estimates around non-farm payrolls, the variation around it is just so wide, the confidence interval, that you shouldn't really use it to make inferences. We actually had a newsletter, I want to say a month ago, talking about how the non-farm payrolls report is really like this Rorschach test, and it just triggers cognitive biases. And it's amazing because it's actually influencing monetary policy. We are now getting a slate of adjustment cuts because of 3 back-to-back non-farm payrolls reports, which we also saw similarly last year. which probably has more to do with statistical aberrations. I won't nerd out on this too much. The non-farm payrolls is based on something called the birth, death, labor model, and the composition and the nature of the workforce has changed significantly. And so you see these seasonal distortions that the model hasn't captured, right? And there's lies, damn lies, and statistics. Non-farm payrolls is all three. The ADP report, the JOLTS report, they're all over the place. They're not that helpful in a modern economy. I like to look at earnings. Company earnings are issued quarterly. They're subject to audit. If you misrepresent as a CEO, you're held accountable, right? That can be fraud. It doesn't mean that CEOs don't paint a rosy picture, but you're getting thousands of companies sharing the inner workings of their business and how they're doing. What more data do you need? This is exactly what Stanley Druckenmiller does too, by the way. Focus on company earnings to get a read through on the economy. So how about the consumer? So let's go through on consumer credit. Obviously, something like 65, 70% of US GDP is consumer spending. Citigroup credit card balances up 9% year over year, driven by strong growth in retail services. Okay, that looks strong. Purchase sale volume went up double digit. Delinquency rates increased 40 basis points. That sounds scary, but what is it? Now it's 2.8%. That's nothing. 2.8% when you have a credit card APR of 18 to 25%. That's nothing. Mark Mason, the CFO of Citi, says, quote, credit trends remain stable and in line with expectations as we continue to see normalization in delinquencies. What he's saying there is that delinquencies are exiting this highly unusually low period and they're reverting to their long-term historical averages, which is a normal phenomenon. JP Morgan's credit card balances up 12% year over year. People aren't taking down the house because mortgage rates are still high. Instead of putting that down payment in the house, they're buying stuff. They're buying stuff at restaurants. They're traveling on airlines. We saw Delta report. Delta exceeded expectations. United's going to report. Of course, United will do well because Delta did well. Let's see. The stablecoins have come up in conversation too. So Citibank, one of the largest international banks with strong payments business. This is a quote from the CEO, Jane Fraser. She says, there's an over-focus on stablecoins. Tokenized deposits are a more promising avenue. They offer faster, safer infrastructure with fewer AML and compliance burdens. And many corporate treasuries are not prepared for 24/7 financial operations. I agree with her. I was at the RWA summit about a month and a half ago, and I was talking about tokenized deposits. I've also written this on Twitter. So let me double click on this concept. Okay, so a stable coin is not issued by a bank and it doesn't pay interest, but the regulations governing how it's backed to ensure those that use it are protected. Okay. The advantage of stablecoin is that you can move it across borders and it is permissionless. There's no KYC or KYB on the receiver or sender. The point of control is the fiat ramps where you get money on chain or off chain at exchanges like a Coinbase and others. That's a stable coin. Okay. Borderless, permissionless money backed by the US dollar or some other asset. A magical thing. It's internet money. It's a kind of internet money and it's cryptographically secured with matching assets at some institution. An amazing thing. So tokenized deposits, instead, the stable coin, you now have this concept of tokenized deposits emerging. And what does that mean? It means you take a deposit at a bank and you put that on chain. You put that on chain. So that tokenized deposit can bear interest to the holder and it can enjoy FDIC insurance like deposits because they are deposits. So I had a fantastic interview with Ben Foreman from Parify. He's the founder of Parify, a very thoughtful TradFi crypto crossover investor. I would recommend having a listen to that. Also had an interview with Austin Campbell, one of the thought leaders in the industry as well. He's testified in front of Congress on stablecoins. Have a listen to that too, if you want to really dig into this. But it makes a lot of sense. Look, stablecoins are good for point-to-point transactions. They're not good as a store of value because of the opportunity cost of capital. Tokenized deposits are a very attractive means to move money, especially if you're a massive merchant like Amazon. Imagine you're settling funds with merchants using a stablecoin and you're giving up the interest on how many billions and billions of dollars. You may be better off using a tokenized deposit, or at the very least, negotiating for a cut from the stablecoin issuer on the interest earned on the back end from the stablecoins. The stablecoin issuers make money by taking the proceeds from issuing the stablecoin and investing in treasuries. So I agree, tokenized deposits are coming, and it's going to be a race. And the small banks and the regional banks won't like what the big banks are doing. The big banks are going to try to get after this, and the big banks will have impact because the big banks have the merchant relationships, right? Citibank issues the American Airlines Advantage card. Fun fact, that was the first credit card rewards program in the world. Chase issues the United Mileage Plus card. So they have the co-brand relationships with these merchants. And those merchants have the distribution to the customer and the loyalty and the rewards programs. So they have a shot at getting after this. However, they risk undermining their own credit card business because their credit cards make money through interchange, and tokenized deposits are an alternative form of payment to interchange. So there's scope for another player to enter the category and offer an alternative form of payment that reduces the interchange costs, the cost of accepting credit cards. So that's the opportunity that folks like Stripe are getting after with their Tempo L2 that they built with Paradigm. That's the opportunity that dozens of fintechs are scrambling to get after. We saw today that Erebor was, I believe, issued an OCC charter. The OCC is a national bank regulator, and they will have the ability to conduct banking payments activity. Others are also after this too. My alma mater, Cross River, Custodio Bank, Lead Bank, which powers Stripe. By now, all these fintechs and payment companies, there's always one bank somewhere. You can't escape the banking system just due to regulation. You just can't. So I think those banks can do really well. I think these small community banks are going to go the way of yesteryear. They are going to face increased irrelevance and competition. I parked in front of Valley National Bank earlier today. I just kind of looked up to see who's going in and out to get a sense of the customer. 65, 70 plus year old. When's the last time you guys walked into a bank? When's the last time you carried cash? I haven't been to an ATM machine in months. It still impacts me here and there, by the way. It's embarrassing, actually, as I don't have cash for like tips now. I'm like, can I send you a Venmo? Can that work? It's like, you don't have a Venmo? What do I do? What do I do? Can you take digital payments? Can you accept stablecoin? So headline is banks are healthy and strong. Banks are healthy and strong. The banks are making money. The banks are lending. The bank deposits are going up. Everything is going up in the banking sector. Capital markets are working. This is good. This is good. The economy is great. Economy is fine. Actually, economy is fine. You don't want it to be too hot. Then they start raising rates and they spoil the punch bowl. This is Goldilocks. This is what you want. So yeah, this is a key sector of the economy we look at. We do a deep dive on the data center theme. We publish this in the Lumida Ledger newsletter that drops every Sunday at 11 a.m. Eastern. We go through the entire value chain in data center, from the NVIDIAs of the world to the Taiwan semis that power NVIDIA, to the component suppliers, to the Taiwan semis, to the hyperscalers like Meta and Google and Amazon. We go through the whole thing. That story is still intact. The CapEx spend is still there, and they're making money on CapEx spend. Meta is getting an ROI in investment, so is Amazon, so is Microsoft. So they're getting ROI. The ROI story is there. It's not a bubble if you're making money on it. There's ROI on CapEx spend. That means the project is NPV positive. You're supposed to do it again. CoreWeave's got a $30 billion backlog on $3 billion in sales with a 60% gross margin. Okay. It's a race to get to the next form factor. All these hyperscalers are pot committed. They have to do it because if they don't invest in AI, then they have trillions of dollars in market cap at risk. They have to be AI relevant and they have to get to the next AI form factor. They don't know what it is. Is it Ray-Ban glasses? Is it a new type of interactive desktop experience? Is it an AI in your earpods? Maybe it's all of the above. Maybe it's some of the above. That discovery is happening now. They're going to continue to invest to identify the next form factor. What else? So there's some highlights on bank earnings. Some of the names that we own Wells Fargo. I think it's benefiting from a major mortgage refinance concept. That's one. Two, the regulators lifted the deposit cap. So there's a rule saying that if you're a bank, you can't have more than 10% of deposits in the United States. It's meant to limit concentration risk. It's a good idea. It's good regulation. There is good regulation, although we have too much broadly speaking, but that's good regulation. And that means that they can grow. They can do acquisitions. You're allowed to exceed that deposit cap, by the way, if you're JP Morgan, if your growth is organic. So that is going to enable that kind of bank to grow. Now, I like the financials here. I've been writing about this on Twitter the day before earnings season. I'm like, hey, look, you're supposed to buy it. I'm not saying buy the stuff now, by the way. Wells is up 7% yesterday. It's up 3 days in a row now. But, that name went up 40% in 1 year. Wells Fargo is up 40% in 1 year. You might not have guessed that. If I were to ask you, how much do you think that went up? It's bank. That's exceeding the S&P 500. So when we look at banks around the world, whether it's Europe, Brazil, South Korea, and the United States, they're generally in uptrends. I think the one exception is like Turkey. And we bought a bank in Turkey anyway. So we bought like the JP Morgan of Turkey, small position. Their currency got destroyed and the whole country's cheap. We're put our toe in the water there. So the other one on a consumer finance theme I like is Bread Financial, BFH. I've talked about this before. I haven't really done a deep dive on it. I do think that name found the lows at the $55 level, but this is it's like a $2.8 billion market cap business that provides lending and payment solutions. They take higher credit risk. They offer co-brand programs with merchants. I don't mind the higher consumer credit risk. They're getting a higher yield. They're getting compensated for the risk they're taking. And I believe they're well managed with a management team that knows what they're doing. But here's a fun fact on this one, by the way. I'm going to share my screen. I love doing stock deep dives, by the way. That's pretty much what I did most of the time when I started making this series, for those who have been following for a long time. But there's so much to talk about. So if you share with me in the DMs, I can maybe focus on one or two here and there. But here's Bread. Free cash flow yield 67%. Think about that. So in a year, they're generating free cash flow that is 66% of their market cap. I look at that and say, yeah, that's bananas. Then you have to analyze, okay, what are they doing as a business model? And this is up like 18% in a year. We established a position at the $55 level most recently, just going into bank earnings season. So I think that's an interesting name. Citizens, I've talked about as well. There are quite a few banks out there. I don't think this is one of find the best bank and just have a big position. I think that's the wrong way to do it, actually, because you can't know ex ante which one will run the most. Sometimes you can do that when it's winner take all, winner take most. This is not like that. Banks have different business models, going after different customer segments. I like Citizens, for example. They're going to the New York market. They've got a growing business. They have a nice high loan to deposit ratio, which was a bad thing in 22. It's a good thing now. It means they can deploy loans. If they track deposits, they can issue loans and make more money, more ROE. There's some banks that are active in stablecoins like Western Alliance. I think that's an interesting angle too. Then internationally, there are quite a few banks we like, especially in the Eurozone. They're really cheap, like high single-digit PE, and these names are up double-digit percentage points. And some of them have buybacks of 7% or 8%. It's like, that seems quite interesting, right? Continue to like the banks and also insurance companies now too. So financials are the largest thematic weight I have in my portfolio right now. The largest thematic weight. So I'll give you one. Here's an example. Allstate may be setting up today the decent entry. This is like more long-term investing now we're talking about here, right? So Allstate is, I'm going to share my screen, essentially back to the 200-day moving average, presents a good technical entry point, but check this out. Guess what you think the PE ratio on Allstate is? What might it be? 4 Ps, 8 times earnings. 8 times earnings. Okay. That's not a bubble. That's not a bubble. The price free cash flow is 6.2 times. And the free cash flow yield is 16%. That's not a bubble. So there's definitely value and opportunities in different areas. I don't know why you'd want to own bonds if Allstate exists. I could tell you a similar story for Travelers Insurance. In fact, a lot of the property and casualty sector is cheap. So Allstate's more like a kind of stable core. It's not gonna, it's more stable. It's got more ballast, it's got more mass, it's got a brand. It's been around for decades. It'll still be around for decades. It meets the criteria of what Buffett would call a quality compounder. It's like a Buffett idea, right? There's another name we own, which has more higher velocity. This is called Heritage Insurance Holdings. This is also an insurance company. This is a small cap. Share my screen here. This one's up like 70% in a year. And the valuation on this is pretty cheap, 6.7 times forward PE. So there's no bubble there, people. There's no bubble. Where's the bubble? Is the bubble in the room with us now? Where's the bubble? The bubble isn't like quantum stocks, but those can run longer than you think. So I think there are a lot of interesting ideas in insurance land. Another one would be Arthur Gallagher. And also the peer group is interesting. I like this technical setup better than what we just saw, by the way, with HRTG. I like this technical setup, what we're looking at here, for those that are watching the screen here. But AJG, Arthur Gallagher, strong EPS growth. You can see that in the difference between the trailing and the forward PE. And I look at this and say the lows are in, high volume. They're growing via M&A. They're consolidating the insurance brokerage space. It's a high margin model. Brokerage is high margin because you're not taking on insurance risk. You're just matching buyers and sellers, and these are long-term recurring revenue contracts. It's a great business model, right? Their peer group would be like Aon or Marsh McLennan. So by the way, one of the things to being a skillful investor is knowing business models, to know these business models. You have to know the peer group. And you have to know what drives those models and when they're in favor and out of favor. Right? For example, when banks are building provisions and delinquencies are going up and it looks like the credit cycle is turning, you don't want to own them. You want to own them coming out of that. And with the insurance companies, or essentially, these are both banks and insurance companies, they're balance sheets. So you have to understand what their interest rate sensitivities are and exposures are. What are the directions of premiums? Premiums are going up. Premiums are going up. Have you had auto insurance renewal lately? It's going up. Car insurance, it has been going up. It's been a big driver of CPI. I think that's well known, and markets mostly know that. Auto insurance companies have had strong runs, but I think property and casualty as well, especially names in Florida, where you have a government that's letting insurance companies raise prices. So it sucks if you're the consumer on the receiving end, but it's great if you're a shareholder. And if you're in a regulated business with a moat and they can raise prices, there's limited competition, that's a great opportunity, right? So there's stuff to do in insurance land. Really broadly, it's hard to find a category that doesn't have a good story. I look at like oil, for example. Price of oil is $58 a barrel. Do you think oil prices are going to go lower than here? If you think oil is going lower than that, then you believe there's like a recession. I don't see that happening. So if that's the case, then these energy companies have already priced in very low oil. If oil goes higher, then those that are indexed to oil should go up. And what's interesting in the energy sector, by the way, is you have these nat gas midstream pipelines. So 30 seconds on natural gas. You have upstream, midstream, and then you have the distribution. The folks that are doing the oil and gas drilling exploration, they have the most risk and the most sensitive to commodity prices because they're taking the oil and gas out of the ground. That's the commodity. They own a commodity. They're mining it, extracting it, and then they sell it. So all this price volatility flows into their income statement. But midstream is just pipeline. They're saying, hey, look, I'll move your product from point A to point B. I'm going to charge you a service fee for that, transport fee. So they're not supposed to be subject to volatility in commodity prices. Interestingly, we found that these nat gas midstream players, they've sold off due to natural gas prices having dropped, but they're not economically linked to that. It's not a rational sell-off. So we're poking around that category too. The leaders in that category would be like Kinder Morgan, ticker KMI. Another one would be like MPLX. Anyway, it's a category to poke around, I would say. Do some homework on it. I wouldn't say it's in the high conviction bucket for us, but we think those are quality businesses, right? We're stalking that category. looking for good opportunities. And nat gas is a beneficiary of this data center boom because energy is a beneficiary of the data center boom because the world needs more energy, needs all of the above energy. So what else? I think we covered a lot of ground. The last thought I'll share with you, I shared this in a live stream. I'm trying to do more short form live streams where I can, just to share some quick perspectives from data points we're seeing. But I met with my favorite discretionary analyst, my hairdresser, yesterday. I had this in a live stream yesterday in case you saw it. She's a mom of 3. Her kids are all adults, age 21, 23, 25. They all live with her. So mom's paying the rent, and she pointed out that her kids earn more money than her because they're not paying mortgage, right? They're not paying the mortgage. Mom is. And they're all employed. And so the prevailing story has been the next trend's priced out of owning a home. The boomers got these homes at low cost when interest rates were high, and they ran up house price appreciation as interest rates lowered. But there's a different narrative here. This kind of cohabitation. They're not complaining. They're happy. They're living as a family. 2 of them are in relationships. It's working. They're saving. They're building their balance sheet, and they're spending. So now with mortgage rates coming down, mom will be better off too, and if and when she can refinance. We don't know when she took out her mortgage, but things are not as bad as they may seem. Remember, newspapers, and they create a headline, they've got to look at both sides. It doesn't mean both sides have equal standing. So you got to sell. You got to sell your newspaper. Fear sells, right? Dog bites man, doesn't sell. Man bites dog, that sells. That's weird. It sounds scary. That's the stuff that sells, right? All right, folks. I hope you had a good one. Again, tomorrow, speaking to Eric Jackson, Lumida Non-Consensus Investing. We will have this on Spotify, Apple, and YouTube tomorrow, by the way, too. So if you prefer listening, you can consume it that way too. All right. Be well. Make it a great week. Have a good one. Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.